And welcome everybody to the LV Home Experts Radio Show. This is where we talk about real estate and financing. So today we are going to be talking about builders' incentives and what's going on in the market. And back in studio today, my host, the co-host, whatever you want to call it, got my man, real estate guru, Dan French. What's up?
What's up, guys? How's everybody out there?
How's everything going?
Good, man. I was shopping. I was just going to get something for lunch today, and man, those stores and all
Busy?
the shopping. I couldn't find a place to park, and I think it's these last minute shoppers. You know,
Oh, is it?
food and merchandise. You know, it's like everybody's just going at it right now.
Hey, I do like that jacket you got on, homie. That's pretty
thanks,
cool.
man. Yeah, I appreciate that. It's a warm jacket, and it was kind of windy today.
Oh, was it?
A little bit. When I woke up at about 6:30.
Yeah.
And I was going into work, and it was a little bit chilly, so I was like, I'm gonna wear the heavy jacket today. You know
what's crazy is we're about to head towards the end of the year. I'm trying to get all the closings in, but at the end of the year,
rush.
I'm sure a lot of lenders, a lot of companies are having backed up with problems. Also, title companies too as well.
Oh yeah.
A lot of clients want to close by the end of the year.
Yeah.
It looks like we got some calls coming in, but we're not going to take the calls just yet. But I'm looking at your jacket that you have right there, man. That's a pretty cool jacket. I got one, but
Yeah.
it's mine's blue. That's a nice Levi's jacket you got on, man.
Yeah, it's warm. Like I have some jackets that are light, and I felt like I walked outside. I was like, I think I'm gonna be cold still.
Yeah.
So I went back and I got the heavy jacket today. I don't normally wear it because it's got to be pretty cold. Because
Yeah.
I'm a little bit thick around, so I sweat probably a little bit easier. You know what I mean? So I don't want to over sweat and be hot. So
You know what's crazy is I bought one of those jackets and they're pretty pricey. And
Yeah.
I got a blue one, right? And I got a large, but I didn't wear it until this year, and I realized like how big it is on me.
yeah.
Because I dropped from like a size large on a shirt down
Yeah.
to like a medium. So now it looks like I'm wearing baggy clothes.
Well, it's because you're in good shape. I mean, you've been
Well, I
working
don't know
out.
about being in good shape.
You don't think so? You don't think that contributes? Like
Oh,
sometimes I buy clothes
Yeah.
and I feel like they fit, and then if I start really getting in like a program or something, it doesn't fit anymore.
Yeah.
So it's kind of weird, but
Well, I haven't gone running for a while.
but I think you got to a good level, right?
Yeah. Where I can like maintain myself. But now it's like, I was building some muscle, but I'm starting to lose all that muscle now.
Yeah.
Now, the other day I did go and ride my bike.
Oh, did you? How was that?
Oh, it was fun. I only made it to like about a half a mile until I made a U-turn on this gravel, and I slipped on the gravel, ruined my bike.
Did you really?
Yeah, I ruined the bike, dude. Brand new bike, less than 80 miles.
Really?
Tore the bike
You
up.
didn't even tell me that.
Oh yeah, you know what? I got it on video. I was gonna send it to you, but I totally forgot. Talking about crash and burn, dude. Like I literally got it on video.
When you ride your bike, do you ride like where the traffic's coming at you, or do you ride with the traffic?
I ride with the traffic.
Really? So isn't it weird that like maybe sometimes the traffic is kind of passing you by, but it's like you can't see what's coming?
You can't, but the places where I tried to ride, there's like a designated bike path. So you do have like 4 feet away from the cars.
Okay, so you got a little bit of separation.
Yeah, exactly. So it's like,
Got it.
If I'm riding right next to a car, I always try to go right next to the sidewalk, but I always try to go in the path where there's actually bike paths. So like Southern Highlands, like that's where you live, right? So
Yeah.
that's where I normally go and ride.
Yeah, and you never swing by.
I don't even know where you live.
Yeah, right.
I mean, I went to your house like maybe once or twice, but I forgot where you live.
Oh man.
I want to talk about buyer incentives, man. The market right now is just going crazy. I don't understand this market. Now, there was an article. I got to pull up that article though.
Yeah, let's pull it up.
But let me find this article real quick. But anyway, what I was saying is like this market is just so crazy right now to the point where builders are really loosening up on their incentives. Like they're really not giving out incentives anymore.
Yeah.
It's becoming a seller's market. And there was an article by Eli Siegel, which is, Eli, right? With the Review Journal. Basically,
we had him on the radio, didn't we?
Yeah. Matter of fact, we got to get him on, dude, because I like his content. and it has to do with real estate, obviously. He's got like the inside works, you know what I'm saying, and what's going on.
Yeah, he gets that. It's like one of those like a VIP pass type thing, you know.
Yeah, basically.
You get all the information.
But there was an article that he was talking about. I should have had this prepared, but you know, like we like to wing it on the radio because that's what we do. But he was talking about how home pricing now is going to surpass 2007 with home builds. Isn't that crazy?
Yeah, it's crazy.
Like,
well, I think too. You know, I mean, people want new, and it's like, well, if you're short inventory and prices are close to new home sales,
yeah,
why not go new home?
Yeah,
you know, it's like if I'm going to buy a home at 354, now you can get some opportunity with existing. We've talked about that, but I mean,
it seems like the sweet spot right now for a brand new home, like an entry level, is about the 450 range.
Yeah,
450 to about 500. You can literally get about 2,000 square feet.
Where's that pool at? Like, where do you?
Oh, you don't even get a pool at that price, dude.
No, was it 5?
I mean, you could possibly get a pool at the 450, but now we're talking a home that's probably like more than 10 years old, 15 years old.
Okay.
In addition to that, you may not even like the location. What I'm starting to realize that a lot of people like brand new homes for some reason.
They like brand new homes, and what I also see is that people that are looking at homes to purchase, they like pools, and I don't know how. I mean, people use them. There's heated pools, but I think the big draw for that is that people really will pay that premium for a pool, or really, you know what I mean? Because I don't know. I see a lot of people I do loans with. They're always like, "I'm really glad I got that pool." I'm like, okay, you know, I don't use it.
Now, a lot of people think that they could buy a brand new home with a pool. Typically, builders won't build a home with a pool. There's a couple of challenges that you're going to have. Number one, does your lender even allow you, right, to build the pool? Now, the reason why a lot of builders will frown upon it is because if the pool company does not finish up on time, because what happens is your lender is going to get an appraisal done to the property. And that could stop the home from appraising in order for the builder to sell it.
Yeah.
But
and
now,
the builders are all about like efficiency, right?
That is correct. That's crazy, huh?
Yeah, it is crazy.
Now, here's this article, all right? Southern Nevada home builders on pace to see most sales since 2007.
Wow.
That's crazy, huh?
Yeah. Is that by Eli?
Yeah, it's by Eli. Isn't that nuts?
That is nuts. It's really crazy.
I mean, the market right now is unbelievable.
Yeah, the market's booming. Yeah, it's hot, man. I mean, and even like I can remember in December's, I was like, you know, we're starting to slow down and things. We're just as busy as ever. Yeah. And it's a blessing, but we're still busy. And it's just like, man, I mean, I'm happy, but you would think that things would start to go the other direction, but they're not.
Yeah. I mean, I get calls. People ask me like, oh, the market's going to crash. I mean, there's a bunch of foreclosures. I'm like, last time I checked, there was only like 49 bank-owned properties. There ain't no market crash here.
The concept.
We've gone up 12% since the beginning of the year.
Yeah, I mean, the concept, like that person saying, like, yeah, would foreclosures contribute to a crash? Sure.
Yeah.
But that doesn't mean that we're going to have one, and it doesn't mean we have data that proves it's going to be there. So, I mean, for me, I just think that you look at foreclosures and what happened back when we really had a crash, where's that contributing factor that you know, that this is going to happen? We don't know. Nobody knows, but I don't see it.
Now, is there anything else going on in the news that you're aware of? What's going on around the valley?
Around the valley?
Anything you heard of?
Not really. I mean, I see that, the Rio just opened up first time. So
when is that opening up?
Well, it's only opened up. It just opened up yesterday.
Oh, did it?
Yeah, that was shut down for 9 months.
Wow.
Yeah, and
I thought they already opened, dude. That's kind of
no. And I drove by there a few times, and that's like right on the other side of the strip. And so that's kind of like a big deal because I used to grow up going to the Rio. I mean,
didn't they have like the world famous buffet?
They had a really good buffet there. Yeah. At one point, I didn't go there. You know, I think like over the last few years, but what was weird is it was shut down and it looked like it was never going to reopen. And all of a sudden on the news, it's like, hey, the Rio reopened. And I'm like, wow, that's crazy. Yeah. So that casino's open. That shows good signs. Yeah. You know, I think that's one of the last MGM casinos that needed to open up. And that was the last one that was stayed shut down, you know, so.
Well, I think a lot of these casinos are now, right? We talked about this. They're only open on the weekends.
That's right.
Also, what are they going to do for New Year's? Because I was told, like, well, actually the news said that they weren't going to do the fireworks.
Yeah, I heard that too. I heard that actually at the beginning of the year.
Yeah. Now, I did speak to a buddy of mine because he works in the nightlife industry, and he said that the roads, they're still going to block off the roads like from Mandalay Bay on down. Mm-hmm. But then if you do that, you know how many people are going to come on out?
Yeah, I mean...
That's pretty dangerous.
That's dangerous, and I think that... you got to really watch what you're doing out there. You know what I mean? You don't want to be... Like, you've seen some... If there it goes back to like... Yeah. I mean, you couldn't even move down on the strip when it was New Year's in the past. So I can't foresee anything happening like that. Yeah, you know what I mean? Where it's just like, shoulder to shoulder. Some people sitting on people's shoulders. Yeah. It's crazy. This is crazy down there, man.
Now, I want to talk about some of the incentives right now with the builders here. It's kind of crazy that...
Big topic.
The builders, okay? Maybe somebody's texting me right now. Hold on.
Yeah. On your
on my
watches?
Phone. Yeah, watches. Oh, let me show you the watches.
He's flossing his watches.
So I just got the new watch here, but then my right-hand man, look at this. I got two. Two.
Who has two iPhone 6 watches, bro? Who does that?
I guess me.
Jeez, man. That's crazy. Hey, but you know what? You could probably like separate them too. You got two phones.
Yeah,
you know
I mean,
you
that's
could probably
true.
Separate them.
Oh yeah, I mean, look how bougie this is. And I got two phones too. If you guys want to call in live in the studio, 702-409-4495. Call in with your real estate question or financing question. Live in studio today at 702-409-4495.
Caesar's got a good question.
Well, before we get into the questions, we're going to leave that for the last part, okay?
It's going to be tying in. No, we're not going to go into the but.
Yep.
Says looking in Inspirata, pros and cons of using a builder lender. There you go.
Okay, so again, we'll answer these a little bit last.
Okay.
Let's get into the incentives here. So what I've noticed right now in the marketplace, okay, a lot of these builders are really not giving out incentives. Mm-hmm. Some builders may give out, taxes, property taxes, transfer tax, and also owner title policy. Mm-hmm. And when it comes to property transfer tax, okay, how do you calculate that? So let's just say you buy a home at $400,000. It's 1% of the total sales price. So it's $4,000. But then what you're going to do is, how do you calculate that? You're going to take $4,000, right, divided by $1,000, which is $400. Mm-hmm. So for $400, right? So now you're going to take $400 times $5.10. So it's $2,000. Then you also have owner title policy, and owner title policy is roughly about $1,200. So really, you are only getting about $3,400. Let's just say.
Explain what transfer tax and owner's policy is, though, because just in a brief description.
So when it comes to transfer tax, okay, the state is going to tax you, right? Because you're buying. It's like you're buying something.
Right.
So that's how they calculate it.
Okay.
Now the owner title policy means that the owner owns that piece of property, but they went through a title company to buy that piece of dirt or buy that property, and they are insured through their title company. So the new title company that you're using, right, just to extract that information, you got to pay for all that stuff. So they charge you $1,200. So in today's customary practices, right, on a resale, typically the seller pays for the transfer tax and also owner title policy.
That's how you write the contract?
Well,
is that what it is?
What I'm going to explain to you is customary practices.
Okay.
So somebody has to pay those fees, and how do you negotiate it? So in today's market on a resale, as a seller, right, that would be seller's fees that they pay for.
Got it.
But because now we're dealing with a builder, what builders now will do is have the buyer pay for it. Okay? Because that's written in their contract, but they're also saying, I will give you the total amount. If it's $3,400, we will pay for it. So they're passing on the fees to you, right? However, they're also giving you a credit. So basically, you're paying for their own fees.
Pretty much.
So are you really getting $3,400 or $3,500 based upon today's customary practices? No and yes. If it was a resale, right, then yeah, you're ahead of the game. But when we look at brand new homes, builders pass it on to you. So it is customary that you pay for.
So it's almost like we're giving you something, but we're also taking it away.
Exactly. So no, basically you're gonna pay for the fee, but we're going to give you the money to pay for the fee.
Okay.
So basically, you're thinking you're getting something when you're really not getting something.
Okay.
Okay.
So is this kind of like a cute thing, I guess?
Yeah. So these are things that you have to take a look out for. Another thing that you should be looking out for, right, with the builder, and I've noticed, is that you can get a credit if you do use their lender. Some builders may give you up to $8,000, $6,000, whatever it is. But if you also read the fine print, it also says in the contract, and you got to let your agent really look at this. It says we will contribute $8,000 up to $8,000.
Up to.
Up to.
That's the key word.
That's the key word, up to. So the closing costs may only be $6,000 or it could be more, but the lender that you are using may not allow you to use all those credits.
Mm-hmm.
Now, typically what I like to do, especially on a resale, any remaining balance to be applied to recurring and non-recurring closing costs. So what that means is, let's just say you got $8,000 from the seller on a resale at this point, okay? At that point, let's just say total closing cost $6,000, you got $2,000 more. The additional $2,000 that's left over, the way it's negotiated, it allows me to take that additional $2,000 that buy down points.
100% right.
Okay. But also you got to find out, depending on the type of loan that you have, am I correct? Mm-hmm. Correct me if I'm wrong. Can you actually buy down points with credit from the seller? Is there a certain type of loan that says, yes, you can, or says you can't?
Any money left over, you can apply it towards the buy down or discount. So there's this thing called the 3% rule where all of your accumulation of fees can exceed what you're paying for that loan.
Give me an example.
Well, like let's say you bought the rate down 2 points, and let's say it costs you 2%, and then to pay all your closing costs and all your fees, it's a 1.5%. Mm-hmm. Now you're sitting at 3.5%. Right now that happens a lot on these lower loans because it's loan amount. So that 3% rule does play in consideration. As you get higher loan amounts, you don't really see that, but it is something to still look at. So I think when you look at buying down rates and things, for the most part, especially with where markets are at today, you'll have that ability to buy rates down if you have an excess of seller contribution. So yeah, it's a good opportunity.
Now I remember we did do a deal like that where I was able to ask for closing costs, right? Mm-hmm. And the leftover money, I was able to do the buy down. Mm-hmm. And that scenario worked out really well because he got a lower interest rate than he was expected to get, and he came out less out of pocket.
Yeah, and it's all about, like, if, for instance, if on a listing, let's say you go for an existing home, right? Like you said, they pay the contribution of owner's policy, and they also pay the transfers tax. So let's say that you said, and also in addition to that, seller contributes 2% or whatever. Yeah. There's going to probably be some excess there. And that's an opportunity. And not only does it help you buy the rate down, it helps your debt ratio overall as well. Yeah. And so that helps.
Now, also in the contract, you just need to make sure you put that verbiage now, because if you don't put that verbiage, and let's just say if you got $6,000 and you only use $4,000, you basically just wash away that $4,000. I mean, that additional $2,000.
Yeah. So you just want to make sure. I mean,
you want to make sure you absorb the whole thing.
Right.
Now, the other thing that I'm seeing with builders, I'm not going to mention what builder this is, but they're now taking reserves on homes. This is crazy. So there is a pretty big builder out here. What they're doing, and this just baffles my mind, okay? They will release like 4 lots at a time. They will attract more interest on these lots. Once they attract the interest, right? I mean, the interest on the property, right? At this point, the people that are interested in the property have to get approved through their lender.
I see.
Now, once they get approved through their lender, they have to bid on the lot blindly, right? And also go through the process of building their home and how much they are willing to spend.
Wow.
Before they even accept the offer.
Wow.
Dude, that is just a crazy market, dude.
Yeah, it is. I think they're just looking for any tactic. It's tactic, right?
It is. What they're trying to do is try to squeeze every dollar dime out of you. Isn't that crazy?
Yeah, it's crazy. It really is, man.
I don't know how these guys are doing it like that.
Well, I think the builders are obviously in a market where they're trying to keep creating that. They want to create buzz, you know, and that's what they're doing. They're creating, just like you said, sometimes they're not really offering incentives, and sometimes they are. And it's dependent on markets. It's dependent on how supply and demand is going, and urgency of people. Like right now, they don't really have to worry about giving out too much incentive because people are they want a new home.
Yeah.
They don't have to try to get people in the doors, right?
Exactly. Especially the price point around the 550 and below, they do have that type of leverage.
Yeah.
Okay. And these builders, they are very smart and very analytical, right? On how they build the home, where they build the home, what they charge you.
Yeah.
These guys are so smart, they'll tap out the market. Like, these guys are so savvy enough where you look at a model home, you fall in love with it, and you're like, oh my God, this thing has the bells and the whistles. But there's the standard products that they give you. You look at it and you're like, damn, I'm getting maple cabinets. Like, they give you the ugliest standard product as possible. But you're forced.
You have four. Is it true? And you have four different just options as far as the build. Is it always four, or is it more than that?
It just depends on the builder. So let's just say if you went to a new track, you found a home that you fell in love with. So if you wanted everything that was for free, based upon the base price, technically you could buy it just the way it is. But then you may go to the design studio. Then you may only have two options of the color cabinets.
Oh, I see.
It may be pink or fluorescent green. And you're like, that's not my colors. So now you are kind of forced to move up, to pay a premium. And you're on a budget. So now the budget is, what could I buy on the next level up? So what they do is give you a little bit more appealing cabinets for another $3,000 more. And you're like, you know what? I can kind of settle on this, but what's the next level up? $5,000. Now you're like, okay, now I kind of have some interest on what I want.
Yeah.
So now they got you at $5,000. You see what I'm saying?
Yeah, it's almost like the old, I'm not gonna say bait and switch, that's not to say it, but it's a great sales tactic. I mean,
these guys are good, man.
They're good, man. You get them in there and it's like, okay, I'm excited and we're gonna give you the base, but hey, you know what? You really want something nice?
Yep.
You're gonna have to pay me. You know, that's what it is. So I get it. It's just, man, I don't think a lot of people understand the process of this.
There's a lot of moving parts. Now, the other thing is that if you read a lot of these contracts, the lot premiums, it also tells you that we could charge you whatever we want. It's all negotiable. There was really no set price.
So when they say from the low, I don't know, 500s, they can always be like, you know what? We're going to sell it for 550.
Well, it's the teaser. So when they say low 500s, it could be 550, 549. That's the starting, which is the base price. But then when you go in, then you have the option to pick a lot, whatever lot's available.
Yeah.
And if it is available, this is what our lot premium is. And nowadays, they are getting away with the lot premiums because if you don't buy it, supply and demand, somebody else is going to buy it.
They do the same thing that lenders do with teasing rates. Same thing. It's like, we're going to offer you the low rate to get the phones ringing.
Yeah.
And turn around, it's like, oh, it's higher. Well,
get you in the door.
Yeah, they just get you in the door, man. It's kind of the same tactic.
And what's crazy now with these incentives, a lot of these builders own the mortgage company. And you are also going to sign a disclosure, right?
Yep.
A business disclosure basically stating that we own this company. And what they're going to do is try to entice you. So sometimes you may be getting a deal, right? From the builder, but you're paying it on the back end from the lending side.
I see.
So it's very important to really take a look at all the numbers. You know what I'm saying?
I think it is too. And I think it's good to have like a realtor. They're always, you got to go with your gut feeling. You got to go with what's best option for you.
Well, it's not even that. I think a lot of consumers, they just don't know how to buy a home because they're not buying homes every day. A lot of people think you just buy a home and that's it. There's so many moving parts. I always tell clients this. You could buy a home the right way, right? The wrong way? Or do you want to buy it the right way, the smart way, and save some money?
I think, too, like you've been doing this a while, having a realtor to really break it down.
Yeah.
I think if I was somebody out there that's a person that's maybe buying my first or second home, like when you buy a couple homes, you kind of get it. But especially if you're buying a new home and you're transferring and you just want to buy something that's nice like that, things change all the time. Yeah. Builders and the concepts of how they market, how things are put on paper. Like we have disclosures and things changing all the time in the lending world. So I think just being up to date with that, like real estate agents should, and being able to explain that.
I just had one of my agents close a deal, and I was looking at the settlement statement. Now, what a settlement statement is, it's a breakdown of where all the fees are going, the total cost. Now, initially, you were working with this lender. I'm sorry, with the buyer. I'm sorry. You were working with the buyer, and what was your origination fee? I think it was $1,200, right?
$1,299.
Okay, so it's $1,300.
Yep.
So I was looking at the settlement statement. They decided not to use you. They went to their local bank. Guess how much the origination fee was?
What's that?
$10,000.
Oh my God.
I swear, dude. I called up my buyer's agent. I said, "Did you educate your buyer of what is going on here?" And he said, "Look, I spoke to them. They wanted to go with it."
Now, let me
$10,000.
Let me say this. Why do some people like?
I don't know. That's just.
Well, look, going cheap is maybe not always the only way, but I think if you're buying a house, which is the biggest investment.
I should show you this settlement statement.
Yeah.
You're going to look at this thing. You're going to shit,
I'm trying to watch dollars on the biggest investment people make, you know?
They could have saved like $8,000, took that on the buy down.
Oh my gosh. That's crazy.
Matter of fact, it was Brett's deal. I called Brett right away. I was like, what's going on with this file, dude?
He must just have money to blow. I mean, he's just suspected. He's like, I'm going to burn this real quick.
Yeah.
So that's, hey, you know, like I said, I always say, you know, we can never tell what somebody did, you know, what to tell somebody to do something.
Yeah.
But more often than not, you know, you want to get your options, but you know, as far as like lenders, sometimes it makes sense to use their lender and sometimes it doesn't. But I think it just comes down to the situation. Also really getting a good, you know, fee sheet to look at, like you said, $10,000.
That's what I'm saying.
That's off the charts, man. You know what I'm saying?
So now I want to get into financing, the financing world. What is going on with the financing world?
Let's get it. So we have a lot of good data coming out for the economy. And what I wrote down is I got a couple things that I wanted to talk about, you know, going into next year. So next year, I'm going to put a video together about what to foresee coming into 2021 and maybe how to strategically, you know, market or not just market, but buy a home if you're going to buy a home, kind of see what's going to go on with the economy. But let's talk about what's going on now. You know, the path of the economy will significantly depend on the virus. Now, we all know that the virus is really going to be dependent on how people get back to work, how investors and also business owners work and how things happen.
Yeah.
Monetary policy is going to be a big factor into that. Also, you know, we look at the stock market and we look at what rates are doing right now, and it's kind of a Goldilocks effect. And what I mean by that is, man, the stock market is doing really well. You know, we talk about these record highs, and then we look at what the rates are doing, and rates are still low.
Yeah.
You know, you look at refinance applications, we're up 124% from year over year of last year.
Oh my gosh, that's a lot.
Yeah, and it's crazy, and it just keeps going. And we're up 4% this past week. Purchases, we're up 26%. Not as much. I mean, this has been the year of the refinance boom, but purchase applications are up 26% year over year. They're not as much. They were down a little bit last week, but overall, I mean, it's a very healthy mortgage world right now.
Yeah.
The Fed, you know, if you look at what mortgage bonds and what they're doing right now, they're still pumping a lot of money, $120 billion into treasuries, into bonds. And they're going to slowly, you know, come away from that. But they're going to keep doing this as long as they need to keep rates low. And I think as long as rates are low, this frenzy in the market is going to stay there. And I think if you start to see that increase at any point, you may see people start to put a hint of caution in there.
Yeah.
So going over what we looked at with Freddie Mac, Freddie Mac continues to purchase mortgages. They topped $1 trillion in purchases this year.
Oh, wow.
Isn't that crazy?
Well, what would you say, what is their percentages of all the loans that are out there? How much of the loans do they carry? Like 50%, 60%? What do you think?
That I don't know, but I do know that.
If you had to take a guess.
I mean, I would say, compared to what FHA and all the other loans you're talking about, like more like what they're carrying as far as mortgages.
Yeah, Freddie and Fannie. I mean,
I would say they're covering the bulk of it. I mean,
would you say like 90% of the loans?
I would say probably more closer to like 70 to 80.
Okay.
But because you have to look at prices are going up, and I'm not saying that FHA loans are not out there to take advantage of, but who
is using an FHA loan nowadays?
Well, there's people out there that maybe in lower areas, county limits, people that maybe have a lower median wage, maybe they're just not as, robust as Vegas is with people moving here and it's just expanding out and people are willing to pay $400,000, $500,000, $600,000, $700,000 for a home. Yeah. So is it out there? Yes. And I think it's still a predominant figure or a position for FHA, but I do think that conventional loans are really taking, the big part of this here. So you look at that, and then you look at, refis, like I said, they continue to dominate the mortgage application market. You look at what's happening with spending right now. Well, I know we're heading into the Christmas and everything, but I think with COVID, with everything going on, you have a decrease in spending right now. Yeah. Consumer personal income has decreased 1.1% in November. So what is going on really? I think people are kind of holding back. We're still going to have Christmas. People are still spending and buying gifts. Are they actively traveling? Are they actively spending their money like they used to, or like maybe last year? Not by these numbers. Yeah. Okay. And then, one of the things I want to talk about is, where are rates going and how are rates doing? Rates are phenomenal right now. Like right now, my rates have fluctuated very subtle. Yeah. I would say anywhere from 2.625 to 3.25, depending on what your credit score is. Damn, right.
That's a high rate, man.
No, I think that's good because see, and I'm going to bring something up. That's a good point. Freddie Mac sells to these bigger banks, right? And just to kind of dummy this down. And then it kind of, by the time it gets to street level, it's kind of divvied up, if you want to call it.
Everybody wants a dip in your pocket.
Right. So Freddie Mac sells to these big banks, right? And then these banks sell to local banks. Yeah. By the time it gets to the consumer out there, everybody's has a part in that. So everybody's like, well, I went on to Freddie Mac and Fannie Mae and the rate is this. Yeah, but by the time it gets to street level, it's a little bit higher. And that's where that difference comes in. Also, I want to bring up this last thing. FHA did extend COVID relief measures until March. And we talked about here in Vegas how that's for anybody to be evicted. And so that's going on right now.
So explain that a little bit more in detail.
Well, they can't, by law, if you have an FHA loan, the landlord can't come in and evict you if you have an FHA, not the landlord, but the bank, excuse me. Yeah. The bank can't show an eviction. Also, if you're renting, they can't evict you as well. But this is pertaining to an FHA. FHA loans, right? The mortgages, you're not going to, there's no foreclosures, there's no like lates, they're going to extend it. And this is what we're seeing with the renting part of it too.
Does that still impact your credit though?
No, because technically what it does, it's like okay, so on your credit report, it'll show as, forbearance, right? Or it'll show, because on your credit, this is really pertaining to mortgages. I don't think it even affects you on the renting side of it. Unless
yeah, but I want to get into mortgages though real quick. Okay, so does it affect your credit score?
Yeah, it doesn't affect your credit score, but what it does do is it causes a red flag on the credit report because on it'll say forbearance. Yeah. And it will say, when you're under a forbearance, obviously it's almost like a frozen account or payment that's not being paid. Yeah. But in some cases, somebody tried to take it. People have tried to take the forbearance, and they said, yeah, I'm not going to do it. So they ended up starting the process. And then they ended up not using it at all, and they kept making their mortgage payment. And in some cases, I had to prove that the forbearance never happened. Yeah. So the opportunities are still there for refinancing. Like I said, it's a refinance boom still. Rates are still low, and we're gonna preach this probably all of 2021. So it's a good opportunity. But the big thing is.
So let me ask you this with this forbearance thing, right?
Yeah.
If it messes up your credit, it freezes it. Let's just say. Once we pass March. Typically, these people that are in forbearance can't make a payment because they don't have a job. Unemployment is 15%. Well, so then what happens from there? So what I'm saying is that if you think about this, eventually, right, if the banks don't work with them because they don't have a job, they can't make a payment, they're probably going to end up just foreclosing on it too, right?
I mean, potentially. I think if it's like this, if I was somebody on there, it's almost like a mediator, right? You're calling your bank and you're going, hey, I need to know if I can be on the forbearance, and what would do I qualify or do I not? Are you guys honoring? Some banks aren't even honoring it.
I just feel like we're kicking the can down the road.
That's exactly what we're doing. That's exactly what we're doing. The problem is that we don't see change. We don't see enough happening in the economy, and COVID keeps rising up. Now they did pass this $900 billion stimulus, right? And what that's going to do is pump money back in the economy. It's going to, spike the economy. It's going to keep the economy flowing. Hopefully, it'll keep gross, GDP going. But I think when you look at the big picture, is it doing anything at a long term? It's not. And as long as COVID's out there and it's running rampant, they're going to keep extending this down, like you said, kicking it. This could be extended till June. It could be extended till into next year. So
let me ask you this: with a forbearance on your credit report, can you still actually refinance to a lower rate?
You can. Now, if you
don't have a job.
Listen. You have to have a job.
Okay.
But
they won't even be in forbearance if they had a job.
Well, listen. No, some people do.
Really?
Because some people are like, you know what? I'm making money, but we don't know what's going to happen. And if you can prove that you're obviously in some type of financial distress to your servicer, and some servicers, like I said, will not take it.
Yeah.
But if they can take it, then what ends up happening is, as long as you're on there, you have a waiting period like after you get back on track. So let me give an example. If I was on a forbearance for 8 months, and then let's say, okay, I'm back to normal, I'm working again, everything's fine. You can refinance, but then you might have to wait 3 to 6 months to refinance your house, because now they want to see that you're back, everything's good. Now, I had an instance where a person wanted to just pay the house off. They had an inheritance, and they went through the process, and they were like, well, I did the forbearance. And they go, well, if I pay this house off, can I buy another one? Absolutely, because you're paying that loan off. Now that forbearance is attached to that loan. You
know what's crazy? A lot of people are like waiting for the market to crash. But I realize rates are so low. Everybody's like refinancing, and people do have equity in their home to the point where, think about this. If they were going to get foreclosed, they would just end up putting the property on the market and just selling it.
Well, you also have to think, though, where they're going to go.
Well, that's true. But here's the thing. If they sell their home and they have like, $60,000, they're going to be able to rent it out.
Yeah, but they're
going to be able to rent a property out. You know what I'm saying?
Well, but let's say this. What if they didn't go into forbearance and they couldn't pay for it? Let's say the servicer didn't have, couldn't help them. If they have lates on their credit, then they might be affected, right?
Yeah.
Even if, I'm not saying you can't go.
You would just put down a bigger, large deposit.
Correct. And that might be the situation.
Well, what I'm trying to get at is how things are going. I think 2021 is going to be the same scene as 2020.
I agree. I think
we're just taking all the trash and just moving it down the road.
That's all we're doing. I mean,
that's how I feel.
Look, they don't have a real grasp on the magnitude of what COVID's doing, not just for people, but for businesses.
Yeah.
And for what's happening across the economy, as far as people really sustaining a good living and not worried about things. And I don't know. I think that when you look at next year, I can see the same thing happening. But I do think that with this stimulus, and if they do get a handle on the COVID, because they are saying that there's a vaccine out for the second quarter, that if all these things come to fruition, then I'll tell you what, I think the economy will recover, and you may start to see the Fed start pulling out a little sooner. They're talking about pulling out purchasing bonds. The whole thing is the Fed has figured out a way to buy bonds, mortgage-backed securities, treasuries, to keep mortgage rates low. And what does that do? It creates people think that there's a sense of urgency, right? Yeah. And so why is there a sense of urgency? Is because now you're getting something, it's scarcity, right? You don't have rates that have ever been this low, and I got to get mine while it's there. Yeah. And so as long as they keep that intact, I don't see why 2021 wouldn't be a mirror of what's going on in 2020.
I personally don't see rates ever going back up. I think this is the new norm at this point.
2021 into 2021, they're saying, or actually 2022, they're saying that they may be almost completely out of buying the whole bond market, as they say. And
so what does that mean?
That means it's going to start to slowly go into more of a free flow or a free market where they're not going to have their hand in purchasing these bonds or treasuries and all these other things, these notes.
Yeah.
And so at that point, they're going to start to see if the economy can just sustain itself. We've seen data, though, that when they start to let that happen, they have to come in and all of a sudden things start to get out of whack.
Yeah.
And I don't know. I mean, when you look at how much money we're printing and all these things that's happening, is it ever going to be a free market where things aren't? I mean, maybe sometimes you just have to let things settle itself out.
Yeah.
And I don't know. I mean, like you said, kicking the can down the road, probably going to be that way. And I think that the Fed's going to really try to manipulate the market, at least for the next year.
Yeah.
I mean, especially with COVID and especially with what's going on and also the stimulus that they just put out. So they're trying every tactic they can to keep this thing flowing.
What else we got on financing?
That's it, man. I got nothing else. Everybody out there, it's Christmas and it's usually a slower time for investing at this time, and so you got the markets closing early.
Okay.
And it's going to be a quiet week.
Now, if you guys want to call into a studio, go ahead and call in live at 702-409-4495. Again, call in live to studio, 702-409-4495. This is where we're going to take some questions here. So what do we got, Dan?
Not sure. Well, I already answered that question. I see one about mortgage bonds. I mean, they're going to be doing as well as they...
What is the question?
How good are mortgage bonds doing? I just, as long as the Fed continues to purchase $120 billion. All
right, let's move on to the next one.
We're good.
All right, let's see here. What's the next one here? Looking to buy an Inspirata. Pros and cons of using builders lenders. Go ahead and answer that question, Dan.
Well, I mean, I think it comes down to...
Sell yourself.
I think it comes down to assets, right? Do you have assets, and do you really need the money? And, I think you have to weigh it out. Sometimes it's better for you maybe to go with the builder, but I think that majority of the time lenders are very competitive against the lenders or the builder's lender. So maybe rate, and I think a lot of times rate's more important on the long term.
Yeah.
So if you get a decent rate or a good enough rate, then maybe it offsets incentives. Also, too, look at what the fees they're charging you, just like you said.
Yeah. The best thing to do is just take both numbers.
That's right.
Okay. And you need to focus on what's most important to you. You want to pay for the money on the back end or the front end. Typically, if you pay it on the back end, right, that is normal for people that want to save money in the long run, right?
That's right.
So it just really depends who you are as a person. Sometimes people just want to pay the money on the front end, get a lower interest rate, but they know they're going to live in a property for some time where they're going to break even.
Yeah.
Okay?
Yep.
So, again, it's really case-by-case basis. You're going to have to kind of run the numbers on that. Okay, what else do we have here? Chakits, you are so special. Oh my God.
You are a special person, Chuck.
I don't think so. I just like to have some fun, enjoy what I do. Hello, Chakits and Dan from CC. What's going on, CC?
She's a main. She's really cool, man. Yeah. I like CC.
No, she's actually a big supporter. So
very big supporter.
Okay, Manuel says hi, Dan. Yo,
what's up, Emmanuel? What's going on, buddy?
Blake says, yo, sup, Jack.
Jack. Oh my gosh.
Can we guess what builders? Not too sure what they're talking about.
I think it was a comment you said about the builder. You didn't want to say names.
Yeah, I can, but I'm not going to.
Yeah.
You got to call us and to find out.
He said, I got a tree for your house. Jamie. Who's Jamie?
Oh, you know what? That's my little niece messing around. Clowning.
She said, I got it. Because I think you said you don't have trees at your house, right?
Yeah,
for Christmas?
That's right. Desi Boo, if you're watching this, Uncle loves you, champ. I believe in you for real. You can do whatever you want to do. I'm going to support you all the way.
That's funny.
What is this? Private banker. What does that say right there? Sounds like one for you right there, Dan.
All mortgages are fraud. Keep that in mind. I understand that each and every mortgage is under blind contract, none as a trust. I don't know. I don't want to get into that.
Yeah.
That's a lot of negativity.
So what is this one right here? So building hasn't slowed down. Home improvement and new homes. Not at all. It is crazy what's going on out here.
No, it is. I mean, the building's not stopped. And look, I think again, I was looking at the housing price index, and that went up too.
Yeah.
Recently, and it's just every single time I look at it, every month, it's just increase. I can't see the last time that it decreased. Now, 5 months ago they thought it might decrease, but at least for the last 5 months, it's been on fire.
Now, this is actually a good question here. Anthony says, should I buy now or wait for the 2008 to happen again? Now, will the 2008 happen again? Well, we can't compare 2008 because that was a whole different market. And if we went to a crash, this would be a different crash, right? Because they're two different years, right? And it could be two different things. It's not going to be the exact same thing.
Yeah.
One thing can impact it. But right now we're dealing with the coronavirus. Based upon a coronavirus, I think we're still doing good.
Well, I think there's got to be a contributing factor.
Yeah. For
that to happen. I mean, what contributed to 2008? I mean,
everybody's got equity in their home. The only way that this market would crash is that supply goes up high. You have hyperinflation, and that's what I'm worried about. Because right now, things are getting really expensive. And the last call that I had, a gentleman was thinking about moving to Arizona, but they are about to raise their sales tax, I think, from like 4.5 to 8%.
They're doubling their sales tax?
Yeah, I think that's what it was. He was telling me that. And he is on a steady income, right?
Wow.
So basically, he's got a budget. So now he's thinking about moving on out here, which makes sense. But now, when you start having more and more people moving on out here,
taxes go up, right?
Taxes can go up.
Housing taxes go up.
Now, the good news is it does cap out at 3% on a primary residence, and I believe 6% on an investment property.
For how much it can go up?
Yep. So I do love that fact. But here's the thing: we don't pay the state income tax, but that's what I'm worried about. Where we change the rules of the game, next thing you know, we're paying sales tax. You think we'll ever end up paying sales tax
on all of our goods here?
Yep.
You mean a state tax?
Yeah, the state tax.
State tax.
I'm sorry, state income tax.
Yeah, state tax. It could happen because if
we need more money,
we're hemorrhaging like they are right now.
Yeah,
I mean, because these casinos are paying all that state tax, but it could change. What if these casinos can't survive? I mean, they're not going to just keep paying state tax for everybody, especially when the economy is growing here. So hopefully it stays that way,
So we need to keep our economy open, basically.
Yeah, we need to keep it thriving, especially for the casinos. That's our livelihood, really, and that does promote a lot of growth and a lot of people coming here. We had 40 million on average in a normal world. 40 million visitors a year come to Las Vegas. So
this is a good question for you, Dan. Can I use my stocks to actually purchase a loan or get a loan?
Of course.
How does that work? Break that down.
Well, you gotta pull your stocks out of the stock market and then put it into an account where you can, wire the funds to, but they're not going to give you a loan using the stocks that you make or the stock value.
Yeah. I would definitely contact the CPA before you even do that, because there's going to be
capital
some tax
gains.
Yeah, there's going to be some tax consequences. So that's something to look out for. But we do those deals all the time where they use their stocks as far as like a down payment.
Yeah, they get taxed on that. I had somebody recently didn't want to do that because of getting taxed.
Yeah.
And what's crazy is the guy bought a really big home, and he had a 1031 exchange. This one we just closed.
Yeah.
And he had a bunch of money in the stock market, and he took a hit on it. Even though he wanted to buy a house, it was more important to buy a house. But it's something to look at, especially if you got a lot of money in the stock market.
If you guys want to call live into the studio, 702-409-4495. Again, 702-409-4495. We did have a call. Unfortunately, I didn't answer that call.
We had one call.
Yeah, one call.
That's all.
Let's not go down that road. So what's the next?
Oh, man.
What do you think it would be next to SUMMERLIN? What do you think it would be next to SUMMERLIN? What are they talking about?
I don't know.
Where do you think it would be next to SUMMERLIN?
What do you think it would be? Oh, what do you think would be the next SUMMERLIN? Where do you think it would be at?
Oh, gotcha. Well, I can tell you what. I just recently shot a video for Red Point. Matter of fact, let me just kind of tell you where this new community is. Get you guys going. And plus, we will have the videos up here in the next couple days. Give me just a second here. So there's a new village out in Summerlin called Red Square. Okay. I'm sorry. Red Point Square. And you have builders like Richmont American Homes. Let me break this down real quick. So there's two new communities, which is the new village of Summerlin for 2020 and 2021. So the first one is going to be Red Point Summerlin Village, okay? So within Red Point Village, you're going to have builders Woodside Homes, Toll Brothers, Taylor Morrison, Lennar, Pardee, and Pulte. So I literally just did some videos up there. That's going to come out next week. I'm going to break it all down. So that's on the west side of the 215 and Far Hills. Okay, so
that's way out there, almost North Las Vegas, close to, right?
Well, it's starting to head out northwest. So
northwest.
The next road would be Cheyenne, and that's where Summerlin pretty much ends. Now, over there on Cheyenne and the 215, you do have a community called Reverence by Pulte, and they had like 10 different neighborhoods. And what's starting to happen is they are starting to connect those two. So the newest neighborhood is the Red Point Square. Elevation up there is about 4,450 above sea level. It's going to be about 5 degrees, a little bit cooler. You do have some nice views. However, they're going to be building a lot of homes. Right now, Summerlin has roughly about 6,000 miles, or 6,000. I think 6,000 miles of homes to be built or something like that up there. I don't know if I'm saying that right. Doesn't sound right now, especially when I'm tweaking out on this coffee. But I'm seeing home pricing starting off about like the 500 range. And you can get some pretty nice homes up there. But I literally just started doing the videos, so stay tuned to that. And videos will start to be released, I'm going to say, next week. So stay tuned to that.
Yeah.
Now, what else do we have?
Just going through it. So next Summerlin is in Pahrump.
Oh, no, that's too far.
That's too far, maybe, yeah.
Yeah.
You think that it would connect out there at some point?
Nah, I think there's so much land to be built out here, and that ain't going to work.
I agree. I mean, I don't know. I've been out there a few times, and it just seems a little bit different of how it's laid out. You know, like the land, it's very flat.
Yeah.
So
here's a good question. What is the minimum you have to put down on an investment property?
Well, there's some programs out there that will do 15%.
Is there a mortgage insurance premium?
In some cases, no, but it's some investors. Now, it's also dependent on the investor.
Yeah.
A lot of it was, going on when pre-COVID, right? Before COVID happened. And so what would end up happening is you can do 20% for investment. That's normally the traditional rule, or 25%.
Yeah.
Now, I say 25% because people are always like, well, why would I put an extra 5% down on an investment property? Well, let's talk about what's going on with Fannie Mae and Freddie Mac. And this is just my opinion. The rates on these loans right now are very high. And the reason is I think that they're trying to discourage people from getting investment properties because they're putting such a high difference in rate.
Yeah.
And so investment properties is like running a business. Investors and people that buy homes like that, they're usually paying a little bit more for rate. Well, now it's like really high. Yeah. And so I even have people that are using a discount.
Yeah.
Now, if you put 25% down, that eases that up a lot. Is that going to be this way forever? No, I think it's because of COVID. And I think that Fannie Mae and Freddie Mac, again, it's just my opinion, they're really doing that so they're kind of discouraging investors and discouraging people just right now, maybe because of forbearance and what's going on, to buy investment properties.
Now, I do want to make a correction really quickly here because I was thinking so damn fast. So I want to retract. It's not 6,000 miles. It's actually 6,000 acres left for the Summerlin Master Plan Community Development. Mm-hmm. So just keep that in mind. That's still a lot of land to be built. You know what I mean? And Summerlin is like the biggest Master Plan community. They have more than 120,000 residents right now. Mm-hmm. Remember, the population in the city of Henderson is 350,000. Isn't that crazy?
Yeah, it's crazy. And
it's almost like halfway, a little bit.
Yeah.
Before it beats the city of Henderson.
Wow. Henderson's been around for a while too, right?
The city of Henderson? Well, the crazy thing, you can't really compare the two because one's a master plan community and the other one's a city.
Yeah.
But it's just kind of like crazy, like it's half almost, it's crazy. And it's a master plan community. What other questions that we have on here? What do we got, Dan?
Let me see. Let's keep going down. Do you think that house values in Nevada will be increasing in the next 2 years? And what percentage had they increased in the past 2 years?
Well, this year has increased about 12%.
Wow.
I don't remember what it was the year before. I think it was like 10%. I think it was. Don't quote me on that. But I think we're going to probably go anywhere from 8% to 10% in 2021. That's my prediction. But I'm just guessing. You know what I'm saying?
That's crazy.
I mean, I don't really know. But that's what I'm thinking based upon what I see. But who knows? I don't know what the hell I'm talking about. I'm just some guy on the other side of the TV.
No, you're good.
For entertainment.
What is land going for in Red Point?
Land right now, the last one that when I was out there, depending on which neighborhood that you go to, but I was out there at Cascade. It was like 15 grand.
Yeah.
And I think the lot setback on that one was like 40 by 1,000. I'm sorry, 40 by 100, which is about 4,000 square feet. So, I mean, that's pretty pricey.
That is pretty pricey.
I mean, you're paying for Summerlin dirt, man.
How much is that square footage?
4,000.
Oh, my. 4,000 a square foot, huh?
No, it's 4,000 square feet for the lot.
Oh, for the lot. I'm like, wait a second. I lost there for a second.
It's 15 grand for 4,000 square feet lot.
15 grand. Okay. That's what I was like, whoa.
I mean, that's pretty pricey, dude.
Yeah. but I mean, I thought it was a lot more than that.
Oh, hell no.
Let's see. What's the next one? If a homeowner is in forbearance, do they still pay their property taxes and HOA fee? That's a good question.
Yeah.
I think if it's escrowed into the account, then no. But there's some people out there that pay taxes and insurance separately, and your HOA is always going to be separate from your payment.
Well,
so
what happens is the bank, they take these impounds like a year in advance.
That's right.
So that way, if you don't make the payments, they can still cover it.
But I don't think it's required that you continue to make the payment when you're going through a forbearance like that. I think it's just everything's on hold. Now, if you maybe escrowed that or didn't escrow it where it's involved in your payment, then you would obviously probably continue to make those taxes and insurance payments.
Now, if the bank didn't pay for it because now they're paying for your mortgage, let's just say a couple years goes by, then the state, right, could actually foreclose on your home.
Yeah.
Now, the Treasury, the state tax, they have a right to foreclose on your home, and they will get first lien position.
Yeah. And I'm doing that because...
That's crazy, isn't it?
No,
the state's like, you don't give us our money for property taxes, we can foreclose. So now that forces the lender to say, oh, I'm going to pay this.
Yeah. No,
That's
you're
how good they
100%
are.
right, man.
Yeah.
You know, and again, I don't...
What a great position to be in.
We don't
First
know
lien
for
position.
sure that that's what they're going to do, but...
Yeah. But I'm just telling you from experience of what happened in 2008. Just remember, property taxes always got first lien position.
Yeah.
They're going to get paid.
Yeah.
Regardless.
100%.
All right, what are you going to say?
Nothing. I was just going to say...
you were going to say nothing.
On that forbearance. Yeah, nothing. There you go.
There you go.
On the forbearance, I was going to say that we don't know I don't know for sure, so I'm not going to come out and say I know for sure that the servicer is going to say you don't have to pay that, but I can't foresee how a servicer would say don't pay your principal and interest.
Well, they want you to pay for everything, obviously, but if you can't make that payment...
But it's part of the payment. So like, I can't see why they would say don't make the principal and interest, but pay the taxes and insurance because we need... I just saying, I couldn't foresee that. Now, if you're already making your payments separately, then I would say you just continue on.
What's crazy is that there are some people out there, when they close on a home, they separate their taxes from the principal interest.
Yeah, that's what I'm talking about.
Why would you even do that?
Well, I think some people like control.
Control what?
Just control of like the whole factor of paying your taxes. And plus, you know what? Here's the other thing is a lot of people, you know, they don't want to, even though there's a small fee, some people don't want to come out of that pocket with that extra money at closing when they do close on a home.
Yeah.
Right? They don't want to pay 12 months plus 2 in hazard insurance. They don't want to pay whatever 4 months of quarter or 3 months that is, plus the future quarter of taxes, which comes out to quite a bit of money sometimes, you know? So, you know, I think it's more people though, 95% of people that I talk to don't want that responsibility.
Yeah.
And they just pay it in the payment.
All right. What other questions we got here?
All right. So let's say, hey guys, can't really talk now, but text. Can I take out my current VA loan to invest a rental property like a condo? I have more left in the loan. I mean, that's VA. If they allow that and there's eligibility there, yeah. More often than not, though, you know, if the loan is like, I think it's over $144,000.
Yeah.
If you had a loan above that, then I don't know if there's enough eligibility left. But again, you just want to call the VA department and make sure that, do I have eligibility for this? They'll let you know.
Yeah.
And then, you can get another one if there's eligibility.
If I had a VA loan, I would actually get a fourplex.
Would you?
I would crush it with a fourplex, dude. Bro, you know the rate of return on a VA loan with a fourplex? That's pretty much like infinity. They're like giving it away.
Censor Deb Moser, do VA loans require mortgage insurance? No.
That's what's great about that.
Also
the rates are pretty damn low too.
Let's clarify though.
Yeah.
Every loan has hazard insurance, right?
Yeah.
In case, and I say hazard because that's home insurance.
Yeah.
But that's in case something happens to the home. But does it have private mortgage insurance to protect the lender? That's no. Okay. You can answer this one. What's the difference between SID and LID and HOA? Maybe I missed this.
Hey, let me ask you that question. Do you know the answer to that? I know you want to become an agent.
No, I know what it is.
Special Improvement District, Local Improvement District.
Okay.
So that's just the abbreviation for it.
Yeah.
But that's what it means. So basically when a developer buys a piece of dirt,
yep,
they got to create up a bond with the city. City comes in, starts digging up the roads, sewage lines, all that stuff. Okay. Then what happens is the builder passes the fee on to you. Okay. Now it's a bond. Typically, they're about a 30-year bond.
Not to you personally, but to the whole community, right?
Well, to each individual parcel.
Parcel. Okay. Perfect.
So now you make a payment. Sometimes it's biannual, right? Or once a year. Could be anywhere from $600 to $1,000. And it could be a balance of $8,000, could be $20,000. So that's something that you're just going to look at in the contract. But also the contract states that it's your responsibility to check up on it. Okay. I recently just did a deal where the builder, the sales agent, told the buyer that we don't have it. So I went to the county website. What'd you know? $15,000.
Wow.
Balance.
And how long do they have, like, years to pay that back?
Well, it depends on how long the bond is and how long they've been paying for it. Typically, builders, they'll hedge against land where they bought like 15 years ago.
Okay.
So the balance could be a little bit lower.
Okay.
You see what I'm saying?
Yeah.
So it's all case by case basis.
Now,
but typically it's like a 30-year bond.
Let's say you sell it and it's not paid up full.
Yeah.
What happens?
You typically just pass it on over to the buyer. Now, if I'm representing the buyer, right?
Wow. So the buyer comes in and says, I want to buy this
it has to be negotiated. We don't know who's going to pay for it.
Oh.
But it's you as a buyer, it's your responsibility to see if there's a balance. And if it is a balance, who's going to pay for it?
Yeah.
So this is something that you would do prior to writing up an offer. So let's just say if there was a balance of $4,000. Then at that point, I would say, hey, Mr. Seller, would you pay for it?
Yeah.
So that way you don't have an extra fee.
So how does that affect somebody if they write a contract? They got to qualify for that payment now too, right?
Okay, so
that's what I'm thinking.
See, you're pretty good, man. You're setting yourself up to tee up.
Yeah, I'm just thinking because my mind's just flowing and I'm like thinking, wait, okay. check.
So what Dan is saying is that typically when you get a loan, right, the lender's going to check the debt to income ratio. You may already be at that threshold, and what I mean by that is you're qualified for 450, right? The home's at 450. Taxes at 1%, that's what Dan's got you pegged out at. But now we find out the home that we're going to write an offer at will have a balance of SIDS and LIDs. That could literally throw your debt to income ratio off. And that's why when you also write up an offer, right, you also got to talk to your lender too as well. You got to run all the numbers. You got to make sure you qualify for everything.
Now compare that to that question of that versus the HOA. What is that compared to an HOA?
What do you mean when it's compared to?
Well, because he's saying, well, what is this, or she or he, I'm not sure, I didn't see who it was, but the question is, what is the difference between a SID and an HOA?
So now the HOA, and I want to break it down for a master plan community too as well, but here's the thing, guys, we're about to get off the show here. We are on here for an hour. I don't want to run it too long. Now, a master plan fee is a fee that you pay for a large development area like SUMMERLIN.
Yeah.
So you get to utilize all the parks, but somebody has to pay for all the sidewalks. People got to pay for the grass. Now, a HOA, typically it's called a sub. That's the technical term, the sub. Now, the sub would be within your community. So let's just say you're going through SUMMERLIN, which is a master plan community, right? You have like a bunch of parks. Everything looks good and beautiful. Now you're going to enter into your private community that's gated.
Yeah.
Your private community may have a pool, right? So you're paying for a fee for that neighborhood that you live in.
Wow.
Now your home sits on a piece of dirt, which is a parcel, right? Mm-hmm. So that parcel that you own may have a balance of SIDS and LIDs. So now you got to pay for that fee.
So it's a combination of both.
Oh, combination of three things.
Yeah. Isn't that crazy?
Master plan, the sub, which is your HOA.
Yeah.
And SIDS and LIDs.
Wow.
Then your mortgage.
Is that to the bank?
All right.
Funny,
any final thoughts, Dan? We got to end this show.
No,
already.
I just want to say, if you're okay, I'm going to say that, I'm putting together some stuff on my channel. Obviously, it's just getting started. You can find me on Dan French. Right.
Okay, so
that's it.
All right. So, guys, thank you so much for tuning in to this channel. Until next time, you guys have a blessed day. Also, if you guys have not had a chance to subscribe to this channel, go ahead and hit that subscribe button. Also, hit that notification button because we post properties every single day. Also, give me a thumbs up too as well. Other than that, until next time.